So hello all my dearest students of South India. I hope you all are doing good. I hope your studies are going on great for your upcoming examinations. So today we are going to start with a revision of taxation of trust and exit tax in full English for you all. So the very first thing that I would like to say in this particular chapter that there are two types of taxation of trust. There are two types of trust and institutions under the income tax law, and accordingly we have divided all of them into two regimes. Regime 1, Regime 2. Regime 1 covers certain institutions and certain organizations which are approved under section 1023C and various sub clauses of that, and regime 2 covers certain charitable and religious trusts which are registered under 12AB and 12AA. Okay. Now, most of the provisions of regime 1 and regime 2 are almost similar only. There is no difference between the provision of regime 1 and regime 2. In the last 3-4 years, the government of India has done one thing very beautifully, that they have made both the provisions at par with each other. So for that purpose, as a student, we don't have to put a lot of efforts in understanding both the regimes. Once you read one of the regime, the second regime is almost equal to the first one. But what is more important for exam is the regime 2, not the regime 1. Regime 2 is more important for the exams and not the regime 1. Okay. Regime 1 also we are going to learn at the end of the chapter, but more focus will be on the regime 2 only. Now, what is regime 2? Regime 2 is a charitable and a religious trust. For a trust should be formed for a lawful purpose. A trust cannot be formed for an unlawful purpose. A trust should always be formed for a lawful purpose. Now, for which lawful purpose? Either it has to be for a charitable purpose or a religious purpose. Is the word charitable purpose and religious purpose defined under the income tax law? And the answer is yes and as well as no. The term charitable purpose is defined under income tax law, but unfortunately the term religious purpose is not defined under the income tax law. That you have to understand in the common language, in the common parlance. Therefore, we are more focusing on the definition of the charitable purpose. So what do we mean by the term charitable purpose? It is defined under section 215 in an inclusive manner. It includes 7 items, out of which 6 items are specific items and the 7th item is a general item. Okay, let me talk about the first 6 specific items first. Charitable purpose include relief of poor, education, medical relief, yoga, preservation of monuments, preservation of environments. These 6 items are specific items covered under the definition of charitable purpose, but there is one 7th item also which is a general point. Any other object of general public utility. But if you want to come under the 7th point, any other object of general public utility, you have to fulfill one additional condition, that is your commercial receipt should be up to 20% of total receipts. Commercial receipts means the receipts, the amount which you charge to your customer for providing the services. Whatever fees you charge to the customer for providing the services, that is known as commercial receipts. So for the 7th point, you have to check this condition. Always remember, for the first 6 points, you are not supposed to check this condition. For the first 6 points, there is no need to check whether it is up to 20% or more than 20% or less than 20%. But for the 7th point, you have to check whether it is up to 20% of total receipts or not. Okay. Otherwise, in the 7th point, you will not enjoy the exemption. So this is what this first part is all about. So very first thing you have to see over here is the definition of charitable purpose. Okay. Now coming to the next part, one of the important source of income for a trust is a donation. This is one of the most important source of income for a trust, and donation can come from 2 places. One, where the identity of the donor is known. Another, the identity of the donor is not known. This not known wala we will see at the end of the chapter under section 115 BBC. Right now I am interested in the first part, where the identity of the donor is known. In that also there are 2 categories. Identity is known, in that there are 2 categories. The donation is a corpus donation or the donation is a voluntary donation. So what is the difference between the two? Corpus donation means a donor is giving a donation with a specific purpose, that you have to use this money for only for this purpose. Okay. And voluntary donation means a donation is given by the donor without any specific purpose. It's a general donation. So what is the tax treatment of that? Corpus donation is exempt subject to some conditions. Now we are going to see that condition in a while, and voluntary donation is taxable, therefore add to the income statement. Okay. So corpus donation is exempt subject to some conditions. So what are those conditions which are exempt, subject to which corpus donation is exempt? Now these conditions are added by Finance Act 2021 with effect from 1st April 2021. Before 2021, there was no need to fulfill any condition to make corpus donation exempt. Corpus donation was always exempt before 2021, but from 1/4/2021, corpus donation is exempt subject to some condition. Listen carefully, what is the condition? The condition is, when you receive the corpus donation, you have to invest that corpus donation in the mode specified in 11.5. Only then it is exempt. Otherwise, it is not exempt. Okay. Suppose I received 100 crore rupees as corpus donation, I have to invest that 100 crore in the mode specified in 11.5. Then only that 100 crore is exempt. Okay. Now, in the next year, when you withdraw that money from the corpus donation and you apply that for the objects of the trust, that is not allowed as an application. So in the next year, when you withdraw that money from the 11.5 mode and apply that for the objects of the trust, it will not be allowed as a exemption. It will not be allowed as a deduction. It will not be allowed as an application. Yes, but when you earn next year some income and again deposit back in the corpus, next year when you earn the income and again deposit back in the corpus, in that year you are going to get the deduction. So be very careful. When you receive the corpus donation, you will not get the exemption directly. You have to invest that corpus donation in the 11.5. When you withdraw and use for the purpose of the trust, it will not be allowed as an exemption. Okay, but when you deposit back the money in the corpus, when you deposit back the money in 11.5 modes, then in that year you are going to get the exemption. So before 2021, all those things were not there. Similarly, one more amendment came in Finance Act 2021 2 years back. What used to happen earlier? Earlier, when you used to take a loan, say you have taken a loan of 10 lakh and you have purchased a building, then you will get the deduction of 10 lakh rupees because you have purchased the building. But now it is not like that. Now, if you take a loan and if you purchase a building, it is not allowed as a deduction. It will be allowed as a deduction when you repay the loan. Whenever you will repay the loan, in that year, you will get the deduction under the income tax law. Check please here. Okay. I hope it is clear to all of you. Now, a related clarificatory amendment has been made by Finance Act 2023 over here that any corpus which has been out of before 2021, the corpus which was there before 2021 and the loan which was taken before 2021, and now if you do that, if you deposit back that corpus and if you invest that corpus or if you repay the loan, then that will not be allowed as deduction. Why? It is very logical, because before 2021 it was allowed as an exemption without doing this. For example, let me give you an example. Suppose if somebody has taken a loan of 10 lakh rupees in 2020 and has purchased a building, has he got the deduction of that building or not? Yes, before 2020, 21 it used to get the deduction, but now the loan is repaid in 2024. So should he get the deduction of that repayment also? It will lead to double benefit, because before 2021, you have already taken the deduction of that building, and now when you are repaying after 2021, you cannot ask for the deduction once again. So these two provisions which came in 2021, which talks about depositing back the amount in the corpus and repaying the loan, if it is pertaining to prior to 2021, then it will not be allowed as a deduction, because it will lead to what? Dual benefit. Okay. What more amendment is made by Finance Act 2023? That is, there was no time limit or there was no restriction of depositing back the amount in the corpus, or there is no time limit to repay the loan to get the deduction. But now Finance Act 2023 has made an amendment and it says that you have to repay within 5 years. Within 5 years you have to repay. Suppose if you have taken the loan in 2021 and if you have utilized that money in 2021, then you have to repay the loan by 31st March 2028, or you have to deposit back the money in the corpus by 31st March 2028. If you don't do this, you are not going to get the deduction. So multiple amendments are made by Finance Act 2023. You have to be very careful. Apart from these two conditions, the general conditions which used to be there earlier also now continue to be there. All these conditions are there since very beginning. Let me talk about all these conditions are also important to claim exemptions under the income tax law for trust. Okay. First, such application should not be in the form of corpus donation. Corpus donation, if you give to somebody, it is not allowed as a deduction. If TDS is applicable, you have to deduct TDS. If the payment of more than 10,000 rupees is made to any person, you have to make the payment by account pay check, account pay draft, ECS, and such other electronic mode. Set off of loss, not allowed. Application is allowed only on actual payment basis, because accrual basis it is not allowed. If you make the payment, then only it is allowed as deduction, otherwise it is not allowed as deduction. You should not incur any money directly or indirectly for the benefit of any person mentioned under section 13(1). If any person who is specified person under section 31, you should not make any payment directly or indirectly for that particular person. And last but not least, the application should be in India, except in some exceptional cases where it is allowed to incur even outside India. I hope it is clear to all of you. Now, next point. Next point talks about what? If there is some excess application which is made by you in the last year, can you carry forward and set off that in the current year? Not allowed. Not allowed, not allowed, not allowed. Any excess application made in the last year, if there is some loss, you cannot carry forward and set off that loss in the current year, unlike you do in case of PGBP and all. Here for trust, it is not allowed. Similarly, if there is any TDS default, then that particular expenses will be disallowed to the extent of 30%. And if there is any payment in excess of 10,000 rupees in cash to any person or other than account pay check, account pay draft, etc., which is applicable in PGBP. So TDS disallowance which is applicable in PGBP and the cash disallowance which is applicable in PGBP shall apply mutatis mutandis here also. Mutatis mutandis means respectively in this chapter also. Okay, I hope it is clear to all of you. Now coming to the discussion of how a trust will compute its income. A trust will compute its income in the following manner. The very first thing, the trust will write the income from the trust, that is all the fees minus all the expenses will be the income. Then voluntary donation will be added over here, not corpus donation. Yes, if the corpus donation is taxable, then that also should be added back, but corpus donation is exempt. If you invest that in the mode specified in 11.5, then that will not come over here. Okay, then after that you will get an exemption of under section 11 subsection 1 at the rate of 15%, and then you will apply your money for charitable and religious purpose. Sir, what do you mean by application for charitable and religious purpose? It means you are applying, you are using money for the purpose of the objects of the trust. The word application is very wider as compared to the word expenditure. It is not only includes expenses, but includes wide range of applications which can come over here. Like for example, you have taken some loan and you are repaying the loan for the objects of the trust, then that is also an application. You have purchased some asset, then that will also consider to be an application, but on that asset then you will not get depreciation. Depreciation will not be allowed. Plus, if you are paying even taxes, even income tax is considered to be an amount of application. Income tax which is generally not allowed as a deduction under PGBP, but here even that is allowed. If you are giving some loans to your education loan to your students in the school or colleges, then that is also considered to be an application of income. Okay, application is a very wider term. Any money which you apply for the objects of the trust is considered to be an application, but there is one condition over here: the application will be allowed only on payment basis, not on accrual basis. This amendment is made by Finance Act 2022, which says that application will only be allowed on payment basis and not on accrual basis. Okay, so you have to pay that. That's what it was written here also. Here also it was written that it will be allowed only on paid basis. That's the reason it is written. Here also it was written that set off of loss not allowed. Here also it was written that your TDS has to be deducted, payment in more than. So all these points which I am telling you now, all those main points are mentioned over there in the amendment also. Okay, that was just a clarification. Now, sir, I want to save tax, sir. I want to save tax. My total income is 10 lakh rupees. Sir, show some ways that in which I can save the tax. There are 4 ways in which I can tell you. There are various tax planning measures that I am going to tell you one by one. First one, you can do one thing, that if you are not able to apply the money for the objects of your trust, if you are not able to apply the money for the objects of your own trust, you can make a donation to another trust. Okay, sir, what kind of trust? The other trust should be registered under 12AB or the other trust should be registered under 1023C. It should be registered in either of the two. Both will be fine. Sir, my objects and the objects of the donee should match or not? The objects may or may not match. If it matches, well and good. If it does not match, it is no worry. You can give donation to another trust also which is not matching with your objects. It's fine. Okay, now there are some important points, but the donation will be allowed as deduction only if it is a voluntary donation. If you give a corpus donation to someone, it is not allowed as a deduction. Corpus donation will not be allowed as deduction under the income tax law for the purpose of charitable trust. One more point which you need to keep it in mind, which is an amendment made by Finance Act 2023, and that amendment is, if you make a donation of voluntary nature, only voluntary donation is allowed. Corpus donation is not allowed only, and even voluntary donation will be allowed only to the extent of 85% of the amount donated. The logic I have told you in the class why it is so, because there was some misuse of donation under the income tax law with the help of 15% exemption. That's the reason they have brought this particular amendment of only 85%. If you give a donation of 1 lakh rupees voluntary donation, only 85,000 will be allowed as deduction. Be very careful. Okay, next way to save the tax, next way to reduce the income is, it's a very genuine point. You are not applying because you have not received the money. So you have earned the money is accrued to you, the income is accrued to you, but you have not received it. Now, because you have not received it, how will you apply it? Without applying, you will not get the deduction. So can I get the deduction? Can I get the exemption over here without applying the money also in the current year? So if you have not received the money, suppose 10 lakh rupees is accrued to you, but you have not received that 10 lakh rupees. So you can make an application to the assessing officer and say that I have not received the money, please give me the exemption. The officer will give you the exemption with a condition that whenever it will be received, you have to apply in the year of that receipt or the year following that receipt. Suppose if you receive in 25-26, so you have to apply in 25-26, or one more year they are giving you as a grace, that is 25 after 25-26 up to 26-27, 31st March 2027 you can apply. If you apply till 31st March 2027, we will give you the exemption. Don't worry about it. Okay, you will get the exemption. So in this case, you have to apply in the year of receipt or the year following the receipt. The third one is a very genuine reason. You are not able to apply, you do not want to apply because you want to accumulate for specified purpose. I have 10 lakh rupees income, I have it in my bank account, but I don't want to apply in the current year because I want to accumulate for a larger purpose. Then what shall I do? You should do the following things. You should fill a form in prescribed manner and go to the assessing officer till the due date of filing of return. Okay, till the due date of filing of return, you should go to the assessing officer and tell him the purpose for which you want to accumulate and the period for which you want to accumulate. The period should not exceed 5 years from the end of the financial year. Okay, it should be maximum 5 years, and you should deposit that money in the mode specified in 11.5, which are mainly government securities. You do all these things, go to assessing officer, fill a prescribed form, mention the purpose, mention the period, maximum 5 years, and you should go before the due date of filing of return and you should deposit that money in the mode specified in 11.5. He will give you the exemption. Okay, now what am I supposed to do in future? In future, you have to withdraw that money within 5 years and you have to apply in the 5th year maximum. So maximum in the 5th year you have to apply. If you do not apply by the 5th year, then it will become the deemed income of the 5th year. Okay. Now what if I withdraw in between and use for non-specified purpose? So in between, if you are withdrawing and using it for non-specified purpose, then also it is deemed income. What if I withdraw in between and give it donation to another trust? Then also it is deemed income. What if I withdraw in between and I put in the non-specified mode? I'm not investing in the 11.5 mode. I'm withdrawing from 11.5 mode and investing in non-specified mode. Then also it will become your deemed income. Okay. And what if I don't withdraw only till 5 years and I do not apply within 5 years? Then also it will become deemed income of the 5th year. Sir, is there any circumstance in which the AO will allow me? Sir, there are the circumstances are beyond my control to apply within 5 years. Sir, I tried my best, but COVID came in between for 2 to 3 years. So that's the reason because of which I was not able to apply within 5 years. It is allowed. The AO may allow you to apply that for some other purpose if the circumstances are beyond your control. Okay. So you can apply for other purpose also, but it should match with the objects of the trust. But AO will not allow you to give donation to any other person. Other purpose means he has to incur that money. He cannot give that as a donation to any other purpose. Okay. Donation is not allowed in future years. If you have accumulated for a specified purpose, you have to apply for that purpose only. If you are not able to apply for genuine reason, then you can apply for some other purpose, but you cannot give that as a donation. Okay. Any other reason is the last point, last way in which I can save tax. Sir, what is any other reason? In any other reason, you can make an application to the AO that I want an extension of 1 year, and the AO will give you an extension of 1 year, and you have to apply the money in the immediately next year. What if I do not apply in the immediately next year? 1 year grace you will get. You have to apply by the end of next year. If you do not apply by the end of next year, it will become deemed income of the next year. Okay. So it will be chargeable to tax in the next year. I hope it is clear to all of you. Now, the next one is a small procedural amendment. I don't think so it is very important. Earlier, the due date for furnishing Form 9A and Form 10 was same as the due date of filing of return under 139(1). So, whenever the trust will file the return, and the trust generally files the return on 31st of October, so Form 9A and Form 10 used to be filed along with the return of income. But now the date of filing this form has been preponed by 2 months. Okay. Now, the Finance Act 2023 has made an amendment which says that Form 9A and Form 10 should be filed at least 2 months prior to what? At least 2 months prior to the due date specified under 139(1). Okay. So if the due date is 31st October 2024, then you should file Form 9A and Form 10 by 31st of August 2024. I hope it is clear to all of you. Next one, Section 11, subsection 7. It says that if a trust is registered under Section 12AA or 12AB, then the trust cannot claim any exemption under Section 10 except few exemption. Like if a trust is registered under 12AA or 12AB, trust cannot claim any exemption except few exemptions. Like no Section 10 exemption can be claimed. No Section 10 except 10(1). Agriculture income can be claimed. 1023C, 1023EC, 1046 and 1046A. These are the 5 exemptions which a trust can enjoy. Apart from this, no other exemption a trust can enjoy. Okay. Now, 10(1) is agriculture income. That is always exempt for trust. Apart from that, no other exemption is exempt for, no other exemption under Section 10 is exempt for a trust. Okay. Now, in this, you have to be very careful. Suppose a trust is registered under 12AA and 12AB. Now, these 4, apart from 10(1), 10(1) is agriculture income. Forget about 10(1). Apart from these 4 are also certain institutions and associations which work like a charitable institution only. So now, can a trust enjoy 12AA, 12AB along with these 4? The law says no. The law says no. The provided that such registration shall become inoperative. The law says that this registration will become inoperative the moment you are approved under these sections. If you are approved under these sections, then you cannot claim this. Moral of the story, you cannot claim both 12AB as well as the exemptions under Section 10. Either you claim exemption under Section 10 or you claim exemption under 12AB or 12AA. You cannot claim both of them. So once you are approved under these Section 10 Section 10 provisions, then you will be deregistered from 12A, 12AB. Can I come back to 12AB? Yes, you can come back to 12AB. You can apply for a fresh registration under 12AB the moment you are again deregistered from the Section 10 notification. So moral of the story, you can either come here or go there. You cannot enjoy both the provisions at the same time. I hope it is clear to all of you. Now let's move on to the next part, which talks about registration and application of trust. When a trust should apply, when a trust should get the registration, for how many years the trust will get a registration, and is there any provision of provisional registration also. Let's talk about all of them one by one under Section 12AB. Now first column is different entities, different categories we are going to cover in first column. Second column, by when the application should be made. Third column, by when the registration will be granted by the government. Fourth column, from which year the exemption will be allowed to the assessee, and the fifth column, for how many years the assessee will get the exemption. The very first thing is all the existing trusts which are registered on or before 31st March 2021 in earlier law. The earlier law was 12A, 12AA. The new law is 12AB. So all those who are registered earlier under 12A or 12AA, they have to make a fresh application. Every charitable trust has to make a fresh application on or before 30th September 2023, and then within 3 months from the end of the month, they will be getting the registration, and they will get the registration, they will get the exemption from that year only, and then they will get the exemption for how many years? For 5 years. Okay, so this first column, this first row, sorry, is for those trusts which are already registered under the income tax law since long back. They have to again make a fresh application. Okay, next to our amendment made by Finance Act 2023, if you are a new trust, okay, and in new trust they have made 2 amendments. Again, there is a new trust. Okay, so what is the difference between the first and the second one? The first new trust is where the activities of the trust have not commenced. Okay, so this is a new trust and the activities are also commencing right now only. So it is coming for the registration for the first time. Okay, so for example, I am absolutely new trust. I am not started with any charitable activity and I am coming for the registration. So I should come at least 1 month prior to the commencement of the previous year. Okay, in which I sought the registration. Then within 1 month I am going to get the registration, but I am going to get the registration only for what? 3 years, and that too it will be a provisional registration. I will not get a final registration directly. Okay, I will only get a provisional registration. But if I am a new trust now, and my activities have already commenced earlier, then I can come anytime. At any time after the commencement of activity, there is no time limit. Whenever you will come, you will get the registration. If you don't come, you will not get the registration. Within 6 months, we will give you the registration, and this registration will be for 5 years, and it will be final registration, no provisional registration for you. Okay, in your case, provisional registration will not be given. Now, the people who have got provisional registration after 3 years, because provisional registration is only for 3 years, right? Provisional registration is only for 3 years. So people who have got provisional registration, so they have to come after 3 years for final registration. So when they will come at least 6 months prior to the provisional registration is completing. Okay, so whenever the provisional registration is completing, at least 6 months prior to that, they will come for the registration, and within 6 months they will get the registration. There was some mistake in the law which I have told you in the class, which I am not going to get into all these things. There is this provision is wrong as per the income tax law. They will very soon make an amendment over here with respect to the income tax law, because this provision is absolutely wrong. So this second part is absolutely wrong. Till here it is fine. Till here there is no issue. At least 6 months prior to the expiry of registration. The second part is wrong. That does not goes with the provision of the law, and it cannot get fit in all the situations under the income tax law. After that, within 6 months you are going to get the registration, and then you will enjoy the exemption for how many years? You will enjoy the exemption for 5 years. Then a trust which is registered for 5 years, are they also supposed to come after 5 years for re-registration? Yes. A trust which is registered under 12AB, they have to come at least 6 months before the expiry of 12AB. So moment 5 years are completing, 6 months before that they have to come for a fresh application. Then they will get exemption, then they will get the registration within 6 months, and then they can enjoy the exemption for another 5 years. Okay, no harm in that. What about the trust which got inoperative under 11.7? Now they want to come back. Remember, just now I have told you, if a trust who gets inoperative under 11.7, it means what? Initially the trust was enjoying under 12AB, then the trust got registered under 1023C, etc. Now the trust is leaving 1023C, and now again coming back to what? Again coming back to 12AB. They can make an application at least 6 months prior to the commencement of the AY. Then within 6 months they will get the registration, and they will get the registration for 5 years. Okay, no worry about it. Last but not least, what about the trust who changes its objects, who modify the objects, who adopts a new objects? Then in that case, earlier I was registered as a relief of poor. Now I want to register as a relief of medical relief also. So you have to make a fresh application within 30 days from the date of adoption of the new object. Okay, then the department will give you an application, give you registration within 6 months, and after that you will enjoy the exemption for how many years? For how many years? For 5 years. Okay, so these are the different categories in which you are going to enjoy the exemption. Now, apart from the last 2 points, the first 4 points are also applicable for an institution which is registered under 1023C and a donee which is registered under ATG for receiving donation. So even a donee which is registered under ATG, an institution which is registered under 1023C, those people also have to make a fresh application. Those people also have to follow the procedure which I have told you just now, except the last 2 points. Okay, the first 4 points everybody has to follow. The last 2 points only 12AB SSC has to follow. Okay, now proviso to section 12A, there were some provisos over here which are deleted by Finance Act 2023. It is what? It is in fact deleted by Finance Act 2023. What was this proviso? This proviso used to talk about, generally when I make an application, I get the registration and exemption for future years. These provisos used to talk about that you can also enjoy exemption for past years. Okay, so that proviso which was giving you benefit to enjoy exemption for past year is deleted by Finance Act 2023. So now you cannot enjoy exemption for past year, you can only enjoy exemption for future years. Okay, this is what this proviso is all about, which is amended by Finance Act 2023. I hope it is clear to all of you. Now, what do you feel? Once a trust is registered under 12AB, then they can do anything for 5 years. It's not like that. Their registration can be cancelled by the CIT under some circumstances. So that's what we are going to learn now. Okay. What are the circumstances? You don't be under an impression that once you get a registration, you can do anything for 5 years. It's not like that. Okay. So be very careful. So there is a 12AB section over here which talks about that. Listen carefully. That where a trust has been registered or has been provisionally registered, and subsequently the commissioner, that is principal commissioner or commissioner of income tax, has noticed or occurrence of one or more specified violation. So if the SSC has done one or more specified violations, or what do you mean by the term specified violation, that we are going to see in a while. So if the CIT noticed that you have done one or more specified violation, then the CIT will cancel your registration. Or if the CIT has received the reference from AO that you have done something wrong, if the CIT has received a reference from AO that you have done something wrong, then also he can cancel your registration. Or if your case has been selected in the risk management strategy of the board, like if it has been selected in AIS, or if it has been selected in SFT, then that basis also the CIT can cancel your registration. So CIT can cancel your registration on 3 bases: or when he notices something wrong, or if the AO tells him, or if he finds something involved in the risk management strategy of the board, that is in AIS, SFT, etc. So in all this case, he will call for the documents from the SSC and he will pass an order. He will pass an order either to cancel the registration. He will pass the order, or he will pass an order to refuse to cancel the registration. If he cancels the registration, it is against SSC. If he refuses to cancel the registration, it is in favor of the SSC. Whatever he does, he will forward the copy of that order to the assessing officer. Okay, he will forward the order to the assessing officer. And what is the time limit to pass the order? That is given on the next page, last line in the box. Okay, it will be passed within 6 months, before the expiry of 6 months calculated. The time limit is very different as compared to the other provisions. The time limit is within 6 months from the end of the quarter in which first notice is issued by the commissioner. Okay, so within 6 months from the end of the quarter. It is not within 6 months from the end of the month or end of the year. So in whichever quarter the first notice was sent, whichever quarter, suppose the quarter was December to it was sent from October to December. So it will be counted within 6 months from the end of December. Okay, I hope it is clear to all of you. Now, one very important thing. One of the point which was mentioned over here is, if the CIT or principal CIT notices a specified violation, then the cancellation of registration will attract. Okay, now what do I mean by specified violation? Come over here. Specified violation is defined, and there are a lot of points which are mentioned over here which can be called as what? As a specified violation. What is the first thing? Where any income of the trust has been applied for other than the objects. The objects for which you are registered, you are applying for other than that object your income. You are registered as a relief of poor, but you are applying the money for some other object, then you are doing a specified violation and your registration may be cancelled. Okay, then you are earning income from PGBP which is not incidental to your attainment of object, or you are not maintaining separate books of accounts for your business. You are doing some business which is not, for example, you are running a school, you are doing a business, it's allowed, but you are not incidental to the business. Okay, in the school you are doing something else only. You are giving that school for the purpose of what? For the purpose of what? For wedding. Lot of school and education institution do that or not? They give the schools for the purpose of wedding. Now that is not incidental to the objects of the school, na? So therefore, in that case, there is a specified violation. You cannot do that. Okay, you are applying your money for any private religious purpose which is not for the benefit of the public. You are applying your money for any particular religious community or caste which is not for in general for public at large. It is only for a particular religious community or caste. Or if you are doing any activity which is not genuine in the eyes of the law, or which is not carried out according to the objects of the trust, then also the registration may be cancelled. You will be held that you are doing a specified violation. Or if the trust has not complied with the requirement of any other law. So if the trust is not complying with the Prohibition of Foreign Contribution Act, because if you are receiving any contribution from foreign country, you have to fulfill the conditions of the Prohibition of Foreign Contribution Act. If you are not fulfilling the Prohibition of Foreign Contribution Act, then you are violating any other law or order or decree of court, etc. Therefore, you will be liable for what? As a what? As a specified violation. And last but not least, if your application which you are making under income tax law for registration, if you have made the application for registration which is incomplete or which contains false or incorrect information, you have given an application for registration which is incomplete, which is false, which is incorrect, then you will be held that you are doing specified violation and your registration will be cancelled. I hope it is clear to all of you. So these are some of the specified violation because of which the registration might be cancelled. Coming to the next provision, exemption from capital gains for trust. How a capital gains can be exempt for a charitable and religious purpose trust. it will be exempt in the following manner. Let me take one example on the board. There is a full value of consideration of 9,30,000, expense on transfer of 30,000 rupees, net consideration 9 lakh, cost of acquisition 6 lakhs, and capital gains of 3 lakhs. Now, if the trust wants to save 3 lakh rupees as capital gains, then the trust should buy another asset, another capital asset of the net consideration, not of 3 lakh rupees. Therefore, to save 3 lakhs, the trust has to buy a net consideration, has to invest the net consideration. If the trust invest the entire net consideration, then full 3 lakh will be capital gains will be exempt. But if the trust does not invest the entire net consideration, it only invests 8 lakh rupees, then the exemption will be restricted to the cost of old new asset minus the cost of old asset, which will come to how much? Which will come to 2 lakh rupees. So if the trust does not invest the entire 9 lakh, it only invests 8 lakh rupees, then the cost of new asset 8 lakh minus cost of old asset 6 lakhs, 2 lakh rupees will be exempt out of 3 lakh and 1 lakh rupees will be taxable. This is what it is written over here. Just check it please. Okay. Now the next few provisions are very much interrelated to each other. Therefore, you have to be very careful with all these provisions one by one. Be very careful. Sabse pehle, the very first thing, section 13 subsection 1. What is section 13 subsection 1? Section 13 subsection 1 says that you are not supposed to do certain things. If you do certain things, then you will be liable for income tax. Your exemption will be denied under the income tax law. You will not get any exemption under section 11 and 12 if you do any of the 4 things mentioned over here, which is mentioned under 13.1a, 13.1b, 13.1c and 13.1d. What are the 4 things that I should not do as a charitable and religious trust? First of all, 13.1a. If you are doing 13.1a, that if you are applying your income for a private religious purpose, you will not be eligible for exemption under section 11 and 12. If you apply your money for a particular religious community, you will not be eligible for a exemption under section 11 and 12. The third one is very important. If you apply the money for the benefit of specified person under 13 and 3, then you will not be eligible for exemption under section 11 and 12 only for that portion of income, not for the entire income. If a trust has an income of 100 crore rupees and 1 crore rupees is applied for the benefit of specified purpose, then only 1 crore rupees will not be eligible for exemption. Remaining 99 crore will be eligible for exemption. Now you will ask me a question, sir, what do I mean by specified person? Specified person is defined under section 13.3 as follows on the next page. It means the author of the trust, the founder of the trust, or any person who has made substantial contribution. Substantial contribution means who has given a donation of more than 50,000 rupees to the trust in the financial year. That can also be considered as a specified purpose, specified person. Or where such author, founder or substantial contributor is an HUF. If these people are HUF, then the member of the HUF can also be called as what? Can also be called as specified purpose. Then the trustee of the trust can also be called as specified purpose. Then the relative of all these people relative, authors relatives, founders relatives, substantial contributors relative, members relative, trustees relatives, managers relatives, all of them will also be called as what? Will also be called as specified person. Then any concern means any entity in which you are holding substantial interest. In any concern, any company, firm, LLP, AOP, BOI in which any of these people are holding 20% or more stake at any time during the previous year, then that entity will also be called as what? I will also be called as a specified person. I hope it is clear to all of you. The law says that you should not apply your income for the benefit of specified person. But in that there is a relaxation, that if the specified person is, if the trust is applying the money on the specified person for educational and medical purpose, then it is allowed. Then there is no harm. Then exemption will not be denied. Okay. If it is applied for education and medical purpose, then it is allowed. Then it will not be allowed. Then in that case, if you provide at concessional rate, suppose if my hospital is there, I am the trustee and my child is not well and I am admitting my child in the hospital and I am charging, my hospital is charging 2 lakh rupees, whereas to others we charge 5 lakh rupees. Then 3 lakh rupees will be deemed to be income under the income tax law. I should not charge them concessional rate. I should charge them normal rate. If I charge them concessional rate, then the differential amount will be deemed income under the income tax law. Okay. Now listen carefully. And one last point over here is very, very, very important again. If you invest in the mode specified in other than the mode specified in 11.5, then also you will lose the exemption under section 11 and 12. Again, will you lose the entire exemption? No. You will only lose the exemption to the extent you invest. Okay. Suppose if your income is 100 crore and if you are investing 1 crore in other than 11.5 mode, only 1 crore will not be subject to exemption. Remaining 99 crore will be subject to exemption. First of all, this is what it is all about. Can I invest in the shares of public sector company? Yes, you can invest in the shares of public sector company. That is allowed. You can buy the shares of depository. You can buy the units of mutual fund. You cannot buy the shares of private limited company. That is prohibited under section 11.5. Now, few things which are related to the specified person, which is related to this third point. Now, next 2 points are related to section 13(1)(c). How it is related? Listen to me carefully, please. Now, when I am a trust and I give benefit to my trustee, I give benefit to my founder, I give benefit to the author or to the relative of these people or to substantial contributor. In short, if I give benefit to specified person, then the trust has to face some consequences and that specified person also has to face some consequence. What's that specified person has to face consequence? For that specified person, taxation of gift will apply under section 56(2)(10). For that specified person, whatever benefit it is receiving from the trust, if a specified person is receiving benefit from the trust, then the specified person will be liable for what? Gift taxation under section 56(2)(10). And what is the consequence that the trust has to bear? The trust has to bear a penalty under 271 AAE. How much penalty? First time if they provide the benefit, then the penalty equivalent to the amount applied. So whatever benefit I am giving you, if I am giving that benefit to the specified person for the first time in my life, in the life of the trust, then amount of benefit given, that much will be the penalty imposed on the trust. What about subsequent time? If I give the benefit for the subsequent time, then 200% of the amount which is I am giving you, that much penalty will be imposed. Suppose first time I am giving you benefit of 1 lakh, then penalty of 1 lakh. Next time I am giving a benefit of 1 lakh, penalty of 2 lakh rupees. I hope it is clear to all of you. Then one special rate has been brought by Finance Act 2021 or 22. I don't remember the year exactly, but the recent one of the 2 financial years, they have brought it. That is 115 BBI. What is this section, sir? In this section, if you are engaged in earning certain specified income if you earn, then you will be liable for 30% tax, surcharge if applicable, and cess, and you are not going to get deduction of any expenses, allowances, set off of loss. Nothing will be allowed against this particular income. It will be directly taxable at 30%, just like lottery, the way a lottery income is charged. Sir, what are the consequences under which we are going to be charged over here? The first, if you are misutilizing your fund for specified person. So if you are using your funds for specified person, then you will be deemed income. Okay. Or if your investment of fund in non-specified modes, if you are not investing in 11.5, but you are investing in some other modes other than 11.5, then deemed income under this section. So regime 1, there is the definite citation, and in regime 2, there is a different citation of section. This is just a reference of section which you may or may not remember. That is your personal choice. Okay. So first is you are misutilizing your funds for specified person, 30% flat tax. Second, you are applying your fund, you are investing your funds in non-specified mode. Third, you are making some defaults in accumulation of income. Do you remember that? You have to accumulate your income for 5 years and then you have to apply within 5 years. You have to invest that in the mode specified. You have to give a form to the AO. So if you do any kind of defaults in that, you will be liable for 30% flat income. Or if you apply your income outside India other than certain exceptional cases, then you will be liable for what? 30% tax. Or accumulation in excess of 15%. If you don't accumulate your income properly after 15%, if you don't apply properly, then you will be liable for 30% tax on that. These are the 5 cases in which you are going to be liable for what? 30% flat, directly flat 30% tax under the income tax law. Next point, listen carefully, very important. Generally, do you remember that we have started this discussion with this particular point only? There are 7 points in the definition of charitable purpose, and the 7th point is the any other object of general public utility. Now, do you remember that if you are any other object of general public utility, do you remember that? Then there is a condition that your commercial receipt should not exceed 20% of total receipt. Now, what if it exceeds 20% of total receipts? If it exceeds 20% of total receipts, will I lose my registration also? No. The law says that under section 13(8), if your commercial receipts exceeds 20% of total receipts, you will lose exemption in that year, but you will not lose what? Your registration under the income tax law will continue to be serving you. Okay, will continue to serve you. They will continue to get the benefit of that. Okay, now the next provision, the moral of the story was what? That moral of the story of this provision was you will lose the exemption, but you will not lose what? You will not lose the registration under the income tax law. The next point is also very important. There are some mistakes if I do in life. Then how to compute the income of a trust? Suppose there are three mistakes which are mentioned by the law. That is, if my commercial receipts exceeds 20%, then how will I compute my income? Because now I am not eligible for exemptions under section 11. Or if I don't get my books of accounts audited, then how will I claim exemption? Will I get exemption, or how will I compute the income? Or if I don't file the income tax return, then how will I get the how will I compute my income? So if you do three mistakes in your life, that is, if your commercial receipts exceed 20%, or if you are not getting your books of accounts audited, or if you are not filing the return on time, then how will you compute the income? How the income will be computed? The income will be computed in the following manner. Okay, where the exemption is denied in any of the three cases. Okay, you will get the deduction of all expenses, but you will not get the deduction of, first of all, capital expenditure. Okay, capital expenditure will not be allowed as deduction. Only revenue expenditure will be allowed as deduction. Generally, if you are a registered trust, then even capital expenditure is allowed as deduction. But for these people, capital expenditure is not allowed as a deduction. Okay. Second, such expenditure is not from the corpus standing at the last day of the financial year. Okay. The expenditure should not be done from last year's money. The expenditure should be done from the current year's money only. Whatever money you have earned in the current year, you have to do the expenditure from the current year income only. You cannot do the expenditure from the last year income. Third, the expenditure is not from loan or borrowing. If you take a loan and incur an expenditure, you will not get the deduction. Okay, you will not get the deduction. Fourth, that claim of depreciation is not allowed if you have already claimed the deduction of that particular asset as an application. Suppose 2 years back you have bought some asset and you have claimed that as an application. You have bought a building 2 years back, you have claimed that as an application. Now after 2 years you want to claim depreciation on that building, that will not be allowed. Further, the expenditure should not be in the form of donation. Even voluntary donation will not be allowed here. The expenditure should be plainly in the form of a revenue expense. It should not be in the form of a donation. If it is in the form of donation, we will not allow you the deduction. Next one, the expenditure should be subject to all TDS deduction. If TDS is not deducted, the expenditure will not be allowed. Further, if the expenditure is made as a payment in cash of more than 10,000 rupees to a person in a day, then it should be by account pay check, account pay draft, ECS, and such as the electronic mode. Otherwise, you will not get the deduction of that particular expenditure. And last but not least, the expenditure, no deduction of any expense or allowance or set off of loss shall be allowed to the assessee under any provisions of the act. Okay, no deduction in respect of any expenditure, allowance, or set off of loss shall be allowed to the assessee under any provisions of the act. Forget about this provision. The assessee will not be allowed deduction under any other provisions also of the income tax law. Now, all these harshness are for which people? Whose commercial receipt exceeds 20%, or who has not done the audit, or who has not filed the return on time. I hope it is clear to all of you. Now let's talk about something which we have left at the beginning of the chapter, that is anonymous donation. Anonymous donation is a donation where the identity of the donor is not applicable. Okay, and it is taxable under section 115 BBC at 31.2% plus surcharge also if applicable, if the income exceeds the limit of surcharge. Okay, now how anonymous donation will be taxable? For that purpose, let us take an example. Suppose you have received a total donation of 100 lakhs. Okay, out of which anonymous donation is 10 lakhs and other donations are 90 lakhs. So will 10 lakhs be directly taxable at 31.2%? No. 10 lakhs is not directly taxable at 31.2%. From this 10 lakh, you get only one exemption. That is this exemption, which I am going to tell you. No other exemption of section 11 and 12 will be applicable to anonymous donation. Anonymous donation is not subject to section 11 and 12 exemption. Only one exemption is allowed, and that to this one. Okay. So what is that exemption? That is whatever is the total donation, take 5% of that, compare with 1 lakh, whichever is higher, that will be allowed as donation. 5% of total donation or 1 lakh rupees, whichever is higher, will be allowed as donation, and the differential amount will be taxable at 30%. Okay. Now the very important catch over here is, very important catch. This is the only exemption which is allowed. No other exemption are allowed for anonymous donation. Now the catch over here is, this 5 lakh will be taxable at 31.2%, and the catch over here is this 5 lakh which is getting exempt now over here, this is not going to be escaped. It is not fully exempt. It should be added to the normal income statement before 15%, and then you claim 15%, and then you apply this money of 5 lakh rupees, this 5 lakh rupees which is getting exempt here, you have to apply that money, and then only you will get the exemption of that 5 lakh rupees. Okay, so remember, the amount which is left over, that is the amount after exemption, that will be flat taxable at 31.2%, and the amount which is exempt, that you have to apply, that you add to the income statement, then claim 15% from that 5%, from that 5 lakhs, and then the remaining amount has to be applied by the trust. Only then you are going to get the exemption. Otherwise, you are not going to get the exemption of this 5 lakh rupees I am talking about. Okay. Now, 115 BBC is not applicable to certain people. That is, if you are wholly charitable trust, then 115 BBC is not applicable. Okay. If you are wholly religious trust, sorry, I said wrongly. I said opposite. If you are wholly religious trust, then 115 BBC is not applicable. If you are completely religious, 100% religious, only religious, 115 BBC is not applicable. In that case, whatever donation you receive receive, that will be treated as a normal donation. It is not exempt. It will be treated as a voluntary donation. Add to the income statement, less 15%, apply the money, and then you can get the exemption. What about 115 BBC? If the trust is a wholly charitable trust, if a trust is a wholly charitable trust, then what is there to enjoy in 115 BBC? Then they will face 115 BBC, that is 30% flat tax. So two extreme cases. If you are wholly religious, 115 BBC is not applicable. If you are wholly charitable, 115 BBC is applicable. What about if I am partly charitable and partly religious? Then you have to keep two donation box. Two donation box has to be kept by the assessee. If you are partly charitable and partly religious, and the amount which is received in charitable purpose, 115 BBC will be applicable, and the amount which is received for religious purpose, 115 BBC will not be applicable for that purpose. Okay, one kind of question was asked in one of the MTPs in the recent one. You can go and check over there. Okay, now coming to the first regime. As I've told you, majority of the chapter is dedicated to the second regime only, but first regime is also, to some extent, it is important. In first regime, the various institutions are registered under different clauses. I'll tell you which one is important, which one is not important. This first and the second one is important, rest of them are not important. Okay, only the first and the second one. The first is an institution which is university, education institution, hospital, medical institution, substantially financed by government. So if your education or medical institution is substantially financed by the government, then your income is exempt. What do I mean by substantially financed? Substantially financed means they should give you at least 50% of the total grant. Whatever is your total receipts, your government grant should exceed 50% of the total receipts. Okay, suppose if the total receipts is 30 lakhs, then the government grant has to be more than 15 lakh rupees. Then only you can say yourself as a substantially financed by government. And if you are substantially financed by government, your income is exempt under section 1023C. Second one is not substantially financed by government. It's a normal institution which is not financed by government. Now, in that case, there is no need to take any approval. You can enjoy exemption if your aggregate annual receipt does not exceed 5 crore rupees. Okay. So if you are a hospital, or if you are a medical institution, or if you are a school or university, etc., then your aggregate receipt of all of them, of school also, of hospital also, taking together both of them, this question has been asked a lot of time in the examination. If the aggregate of both does not exceed 5 crore rupees, it is not individually 5 crore. School and hospital aggregate should not exceed 5 crore rupees. If it exceeds 5 crore rupees, you have to take an application, you have to make an application, you have to take an approval. If it does not exceed 5 crore rupees, you don't have to take any approval also, directly it is exempt. Okay. Then there are certain other institutions which are covered under different clauses, like 1023C subclause 4. Any other fund or institution. Now this is for what? Charitable purpose. The next one is for what? Is for religious or charitable purpose both. The next one is solely for education purpose, and the last one is for what? Is for health purpose. Okay. So these are registered under different clauses. According to that, you have to give the registration to the assessee, out of which the first two are very, very important for examination. The rest four are not very important for the examination. Okay. Now, next few procedural points. After that, we are done with this chapter. Then we'll go ahead with the exit tax provision, which is also very, very important. Books of accounts and audit requirement. If the total income of the trust before giving the exemption, exceeds the basic exemption limit. So before giving the exemption, if your income is more than 2.5 lakh rupees or 3 lakh in the new regime, then you are supposed to maintain books of accounts. Maintaining books of accounts is mandatory, and also conducting audit is also mandatory. You have to do both the things. Okay. You have to maintain the books of accounts. You have to conduct the audit when your total income before giving the exemption exceeds the basic exemption limit. Okay. Now, the next provision is only for religious places like temple, mosque, church, gurudwara, etc. Now, they have been given one option by the government of India that if there is any temple, church, mosque, gurudwara, and if they are receiving any voluntary donation for the purpose of repair and renovation. Listen carefully. I am a temple, church, mosque, gurudwara, and I am receiving some voluntary donation for repair and renovation of the temple, church, mosque, gurudwara. Then in that case, I have an option that I can treat that money as a corpus donation. I can treat that as a corpus donation, and I can claim exemption subject to the conditions of corpus donation. Now, what are the conditions applicable to this? So, the property should be temple, mosque, church, gurudwara, etc. And you have received a voluntary contribution for repair or renovation. Okay. Then I have an option to treat it as what? To treat it as corpus. Okay. I can treat that as corpus subject to some condition. By treating it as corpus, I will enjoy the exemptions under the income tax law. Now, what are the conditions? The trust will apply such corpus only for the purpose. That is only for repair and renovation. The trust should not give that as a donation to any other purpose. Okay. It maintains separate identifiable corpus, should be separately maintained. Okay. And it invests that corpus in the mode specified in 11.5. If they fulfill all these four conditions, What are the 4 conditions? They should apply the corpus only for the specified purpose of renovation and repair, and they should not give any donation. The corpus should be separately identified. They should maintain separate records for that, and they should invest in the mode specified in 11.5. If they fulfill these 4 conditions, they will enjoy the exemptions. Otherwise, they will not. They will treat that as a voluntary donation. Listen, this is a voluntary donation which can be treated as corpus donation subject to these 4 conditions. If you violate any of the condition, then it will be treated as a voluntary donation, as simple as that. And last but not least, one of the important conditions to claim exemption under the income tax law for a trust is filing of return. The trust should file a return, but under which section? Either it should file return under 139.1 or 139.4. Whether an updated return can be filed to claim exemption? No. An updated return cannot be filed to claim an exemption. If they want to claim an exemption, they should file a normal return or a belated return. They cannot file an updated return to claim an exemption under the income tax law for the purpose of trust. I hope it is clear to all of you. Now, the next chapter, which is a continuation of taxation of trust only, that is the reason we are dealing it with this chapter only. That is exit tax or accredited income. Sir, what is exit tax and accredited income? What purpose does it exactly serve to us, all of us? Listen carefully. Suppose you have made a trust, you have registered under trust, and then you are claiming lot of exemptions, and after claiming exemption, you are closing your trust, you are dissolving your trust, or you are getting what? You are getting merged with another entity which is not eligible for trust. This is wrong. You should not do that. We have given you lot of exemptions for what? For serving people, not to just claim exemption and then merge with a business entity, not to just claim exemption and then leave your purpose for which you have been created. You should not do that. So the moment you cease to be a trust, the moment you dissolve to be a trust, or moment you convert into another entity which does not qualify to be a trust, you will be liable for an exit tax. How much exit tax? Exit tax will be liable for. How to compute exit tax? It is very simple. Aggregate of all the FMV of the assets minus aggregate of all the liabilities. The differential amount will be considered to be your accredited income. On that, 34.944% tax will be imposed on you. How much percentage? 34.944% tax will be imposed on you. Okay, this much tax will be imposed on you, as simple as that. Okay, 34.944 flat tax rate is there. Yes, flat 34.944% tax will be imposed on you. But accredited income is not imposed on certain things. There are 3 items on which you will not be considered under accredited income. 3 incomes will not be considered an accredited income. First, if you have purchased any asset out of agricultural income. So if you have purchased any asset of the trust out of agricultural income, say you have earned an agricultural income of 10 lakhs, with the help of that 10 lakhs, you have bought a land of 10 lakhs, and that asset is there in your total asset. So don't take that asset in the total asset. Okay. Second. If you have purchased any asset or if you have incurred any liability from the date of creation of the trust till the date of registration. Say for example, in 2006, your trust was created, and in 2010, you got the registration under 12AA, 12AB, whatever it is. So any assets and liabilities which are purchased or incurred between 2006 to 2010, that is before the registration was granted, should not be taken in accredited income. Okay, this is what this point wants to tell us. Third one, if the trust is dissolved and they have transferred the asset, if the trust is dissolved and they have transferred the asset to another charitable trust within 12 months. So if the trust is dissolved and they have transferred the asset to another charitable trust within 12 months, then that should also not be taken in the calculation of accredited income. Okay. Now, while calculated the accredited income, these 3 relaxations are there. No other relaxation is there. No deduction of any expense of any allowance will be there. And none. After that, you have to pay the tax within 14 days. If you don't pay the tax within 14 days, you'll be liable for interest at the rate of 1%, etc. What is the tax rate over here? It is 34.944%. It is also MMR, but the MMR for the purpose of this section is different from the MMR for the purpose of other sections. Okay. For the purpose of this section, the MMR is 34.944%. Apart from this, in the entire income tax law, wherever the word MMR will come, you have to pay tax at the rate of what? 42.744%. Okay. Now, how to compute this accredited income? For that, the law has made a rule, Rule 17CB. Now, Rule 17CB will teach us how to compute accredited income. Sir, what does Rule 17CB says? Rule 17CB says that take all the FMV of all the total assets of the trust minus all the liabilities. Now, how to compute the FMV of total assets? Let's see that step by step. Then we'll see how to compute the total liability. FMV of total assets, you have to take aggregate FMV of all the assets, but you don't take 2 things in that. Don't take 2 things in the total assets. Okay. Don't take TDS, TCS, advance tax. Taxation will not come over here, and don't take fictitious assets. If there is any fictitious assets in your balance sheet, don't take that also. These 2 items will not come in the aggregate of all the assets. Okay. Apart from that, all other assets will be taken. But how to compute the value of all assets? For that purpose, the government has categorized all the assets into different categories. Category 1, Category 2, Category 3, Category 4, Category 5, Category 6. So one by one, we are going to see all the category. First one, in your all the assets, there might be different types of assets. First, if there are quoted shares and security, like listed shares and security, what will you do? You will take average of the lowest and the highest price on the date, on the specified date. Specified date means on the date on which your trust is dissolved or your trust is got converted into another entity which is not charitable. So whichever date you are no more a trust, that date will be called as a specified date. So for quoted shares and security, you will take average of highest and the lowest on the specified date. Okay. And if on specified date there is no trading, then you will go to preceding date. Suppose a specified date is 25th of Jan. On 25th Jan there is no trading. Then take 24th Jan, 23rd Jan, 22nd Jan, on whichever date trading was done. Okay. Now the next one is the most important part and the most difficult part of this calculation. That is how to value unquoted shares, equity shares, not preference shares. For preference shares, there is a simple way. For unquoted equity share, there is a long way. That is A plus B minus L into paid up value divided by paid up equity. Okay. What is A now? A is book value of all assets. Again, do not include TDS, TCS, advance tax. Now, this is the value of which company? Is it the value of us? No, no, no. It is the book value of the assets of the company in which you have invested. It is the book value of the equity shares of the company or in which you have invested. This is not our book value. Okay. So, A will include book value of all assets in the balance sheet. Except don't take TDS, advance tax, don't take fictitious assets. Don't take bullion, jewelry, precious stone, artistic stone, work, shares and security, immobile property. That is covered in point number B. Okay. For point number B, all these assets which are excluded here will be covered in point number B. And for bullion, jewelry, precious stone, artistic stone, shared security, immobile property will be valued as per this rule. And as per this rule, what is the rule? That is mentioned in point number 3, 4, 5, 6. Okay. So you have to be very careful. What is A? A includes all assets except two items which will never come: TDS, TCS, advance tax and fictitious assets, and some items which will come in point number what? Point number B. Okay. Point number B, and point number B says that you should value as per this rule. Okay. Then you should see the liability. Liability, you will take book value of all liabilities, but you will not take these liabilities which are mentioned over here. You will not take contingent liability other than arrears of dividend. Arrears of dividend you will take. Okay. Contingent liability you will not take, but arrears of dividend you will take. Second, amount set aside for payment of dividend you will not take. Any reserves and surplus you will not take. But in this also, any reserves and surplus set apart towards depreciation you will take. If it is set apart toward depreciation, you have to take. Provision for tax you will not take. Okay. Provision for uncertain liability you will not take, and cumulative preference shares also, if it is there in the balance sheet, you will not take in the total liability. After this, you will get the value of that company. Okay. The value of that company, that will become your value of unquoted equity shares. Okay. What is the third thing? The third thing is valuation of shares and security other than equity shares. This will include preference shares which are unquoted. Okay. So preference shares which are unquoted will be valued as per the market value, which will be determined by merchant banker or an accountant. Okay. For immobile property, no book value. Don't take book value. Either take price, market price, or take the stamp duty value, whichever is higher. Market price or stamp duty value, whichever is higher. The next one is also a very, very dangerous part. Valuation of a business undertaking. Suppose you have some stake in partnership firm. You have 30% stake in a partnership firm. Then how will you value that? So you have to do A plus B minus L of that partnership firm. Okay. And how to do A plus B minus L? Just like you have done for unquoted shares. Do A plus B minus L of that partnership firm, and then on that, how much stake you have? 30%. Multiply by 30%, you will get the value. And apart from this, if there is any other assets, you are going to take what? You are going to take the market value, not the book value of that particular asset. Okay. So all the assets are covered. Now, from all the aggregate of all assets minus aggregate of all liabilities, how will you compute the liabilities of the trust? Book value of all the liabilities, but you will not take these items in the book value of the liabilities. Don't take capital, don't take accumulated fund, don't take corpus, don't take reserves and surplus, don't take unasset and liability, don't take provision for tax. Then what will come? Creditors will come, loan will come, outstanding expenses will come, all these things, utility bills, etc., normal business expenses which are outstanding, all those things will come over here. Okay. This is how you are going to compute the accredited income or the exit tax. One last thing over here is an amendment made by Finance Act 2023, which is a beautiful amendment. You all know that if a trust which is already registered on 31st March 2021 under the old law, do you remember that trust has to make a fresh application by 30th September 2023 for a fresh application under 12AB? Yes or no? So if you are already registered under the old law, you have to make an application by 30th September under the new law. So now, if you don't make an application by 30th September under the new law, you are no more a trust now. The law says that. And then in that case, you are violating the provision of the law, because the law has given you the last date to make an application till 30th September 2023 to re-register yourself. And if you do not re-register yourself, then there will be an exit tax which will be imposed on you as per the provisions of Finance Act 2023. I hope it is clear to all of you. This is what this chapter is all about. That is taxation of trust, and that is exit tax. After this, I will also upload non-resident taxation for you all in English. Don't worry. I'm trying my best to upload maximum topics that is possible from my side in English also. And also transfer pricing, at least these two topics I'm going to upload it for you all, don't worry. Okay, till then, take care all of you. Bye all of you. Bye.